on Mornings with Maria. Well, we are awaiting the July jobs report out in about 4 minutes' time. Economists are expecting 175,000 non-farm payroll jobs to be added to the economy in the month of July. Expectations for the unemployment rate are for the rate to hold steady at 4.1%. Joining me now ahead of the number is Zip Recruiter Chief Economist Julia Pollack, Heritage Foundation economist and Trump economic advisor Steve Moore, Macro Mavens President Stephanie Pomboy, and ERShares CEO Joel Shulman. Also with me in studio, John Lonsky and Cheryl Casoni. Great to see everybody. Thank you so much for being here. Steve Moore, kick us off here with your expectations and your assessment of today's economy and jobs market.
No question the economy is slowing down. I'm not saying recession or anything like that, but I think the economy, it's been very hot for the last year. All of the business owners that I'm talking to in the last couple of months are saying things are not nearly as good as they were a few months ago. And I'm going to take the under on that 175,000 estimate. I may be wrong. These numbers fluctuate so much. Also, I would predict that we're going to see some more downward revisions of the previous month's estimates.
Stephanie Pomboy, your reaction and your thoughts going into this number. Dow futures right now down about 289 off of the lows of the morning.
Well, I agree 100% with Steve that we'll see downward revisions to the prior numbers. That seems to be standard operating procedure. The headline print is going to be really tricky this month because the seasonal factor is massive. The economy typically loses 1 million jobs in July. So getting this number right is very challenging for the BLS. And we know that their track record of getting it right in a normal month is pretty slender. So there's that factor. And then we have the hurricane that hit Texas at the beginning of July. So who knows what this print will be. But I agree with Steve. We'll probably see downward revisions. And longer term, I think the trend is pretty clear that we're seeing a deceleration. I think the unemployment rate continues to move higher, probably sharply higher. And we're seeing earnings announcements that are very disappointing, especially in the consumer-facing companies, and layoffs. Along with that, as I've said forever, the number one input into job growth is profit growth. So that's really the key thing to watch going forward. And so I expect this will be, a moderate report and in the trend of decelerating employment growth.
Cheryl, you're on the numbers. You're going to get those shortly. Mm-hmm. What are you focused on mostly, Cheryl, this morning?
The revisions are going to be, I think, very important, but I'm also going to be looking at that government jobs number as well, which we don't have an estimate for. And then also earnings. I mean, if that inflationary story is going to come out of the earnings picture in this report, that's just another reason that you could get one Fed cut, 2 Fed cuts, who knows, maybe 3. The predictions are all over the place for that.
Yeah, we've got great data on the jobs from Steve Moore. And Steve, you're going to walk us through that chart that you have of Biden's jobs are largely government jobs. But Julia, I want to turn to you right now before this number comes out and tell us where you're seeing job opportunities today, Julia.
Healthcare and government are the main drivers of job growth right now. So my focus will be on private sector job growth outside of healthcare and social assistance. For the last 3 months, that number has been running at an average of just 58,000, 60% lower than what it was before the pandemic between 2015 and 2019 on average.
Yeah,
so that means the private sector labor markets are anemic.
That is exactly what Steve Moore's chart tells us, that it's been healthcare followed by government jobs that are where the jobs are. And I want to see if that continues in this upcoming report. Steve, we'll show that chart in a few minutes once we get these numbers out. But let's just assess these markets going into this number, because the Dow Jones Industrial Average right now is down 314 points, just spiked lower. The NASDAQ is down 298.
Yeah.
Cheryl, you've got the numbers.
Got it. We came in much weaker than expected on non-farm. We came in at 114,000 jobs on non-farm. The estimate was 175,000 jobs on non-farm. The employment rate unexpectedly went up. We went up to 4.3%. We were looking for a rate of 4.1%. Government jobs, 17,000 on the government job story, and that is actually a lot less than what we got last month. Remember, last month on government jobs, we had 70,000. Now we've only got 17,000. All right, private sector jobs, 97,000. Again, that is much weaker than expected. We were looking for 148,000 private sector jobs. Factory jobs, only 1,000. Now to the earnings picture. Average hourly earnings at 3.6%, and that is year over year, 3.6%, just to be clear. I think I almost gave John Lonsky a heart attack next to me about 2 seconds ago. 0.2% higher on month to month. That's a little bit weaker than expected. So those are a little bit as far as labor force participation rate, 62.7% is labor force participation rate. So those are the big numbers that we were looking for. Let me get into the report really quick and give you again to see where the jobs were, because we always get that breakdown from the government for the month of July. They do say that employment continued to trend up in healthcare, in construction, transportation and warehousing, but information lost jobs there. And again, these are the two surveys put together, Maria. I'll send it back to you in the panel for more reaction, and I'm going to dig further into the report.
John Lonsky, your reaction to this report for July. Markets are tanking, let me just point out. Dow Industrial's down 500.
The markets are no longer worried about inflation. Instead, they are becoming worried about the possibility of a recession. My goodness, if you get 3 consecutive monthly readings on job gains that are less than 125,000, we only had 114,000 for the month of July, I'm beginning to smell a recession coming into view if that's the case. This jump by the unemployment rate, my goodness, 4.3%. This is up sharply from, not long ago. Where was it? At 3.5, 3.6%. This is a bearish report for the U.S. economy. The market has it right. We have strong reason to be worried about the sustainability of corporate profits looking ahead.
Yeah, and of course we've got a couple of doozies this morning. Intel is down sharply this morning on some weakness in its quarter. John Lonsky, what do you do now if you are expecting a recession and you got this rollover? The Nasdaq is down 8% since July 11th. 7.8% since July 11th. That's when tech started to roll over.
Well, Maria, before this report came out, I looked at Fed funds futures. I almost fell off my seat when I realized that Fed funds futures was assigning an implied probability of 100% to 3 rate cuts for 2024. And now I think we're perhaps looking at the possibility of a half of a percentage point cut in the federal funds rate on September 18th.
Maria, that's what the market's betting right now. I was just looking at those numbers as John was talking. 2 and 3 are now saying we're going to get a half a point cut in September.
A half a point cut. That I wonder if that would scare the markets, by the way. A half a point cut as opposed to a quarter point. We've got these revisions. The June number revised lower from 206,000 to 179,000. Joel Shulman, your reaction to this market sell-off? You got Treasury yields down 17 basis points right now, with the 10-year at 3.8%. Stocks down 530 points on the Dow. Triple-digit sell-off in the Nasdaq. We are going down fast here.
Yeah, this is a bad job report. 114,000, expecting 175. I mean, what's interesting here is, as you noted, the likelihood of 3 rate cuts now is very high. I think the market may respond next week in a positive manner to the extent that we're going to have continuing rate cuts. And actually, I wouldn't be surprised the market comes off the lows right now, because they're building in expectations of more rate cuts, and that's generally bullish for the market. This has been a very bad jobs report. It's showing a weakening to the economy. I don't think we're moving to a recession. I think the market, after it starts to reflect on more rate cuts and larger price points, perhaps in September and then November, December, we're going to see the market look at it, reflect, and say, okay, lower interest rates are beneficial. The market, I think, is going to come off the lows.
Well, what a crock on these jobs numbers. Give me a break. Look at all these revisions from Charlie Brady at Fox Business. The May revision down 2,000. June revision down 27,000. Revisions to May and June combined show 29,000 fewer jobs created than previously reported. Steve Moore, let's go through your chart. And this is your chart from the Committee for Responsible You've got this is actually Bureau of Labor Statistics. My mistake.
Yeah, that's right.
Bureau of Labor Statistics. Biden's jobs are government jobs, and you've got healthcare is the leading job creator, followed by government jobs. Is this what we see in this report again?
Well, government, I think the number was smaller for government growth, but government should not be hiring more people. The government should be laying off hundreds and hundreds of thousands of people. My God, we're running a $2 trillion deficit. We have to downsize government, Maria. We have to, I'm in Washington, D.C. I think I mentioned this on your show a couple weeks ago, that only 6% of federal employees are showing up on the job 40 hours a week. 6%. So you got people making $150,000 a year working 25 hours a week, and that cannot continue. The other thing I would say, I was just looking at the numbers because, as you know, we've talked about this many times. There's an establishment survey, which is the numbers we've been talking about, but there's also a survey of households, and that household survey shows, this is unbelievable, that over the last year, since July of 2023 versus July of 2024, there's been a net zero job growth. So I've got to try to figure out why there is this wide discrepancy in these numbers, but it is absolutely clear the economy is slowing down. Inflation is coming down, but so is the rate of economic activity in this country right now.
Stephanie, you mentioned the fact that the July hurricane could be a factor. Cheryl just tells me that was a factor in July. Your reaction to these numbers?
Well, I think I can answer Steve's question as to why there's this massive gap between the payroll and the household survey. And that gap before this number was running 2.4 million over the last year, with payrolls showing 2.4 million more jobs than the household survey. And that is this birth-death imputation that the government uses to try to figure out how many new businesses are hiring people that haven't yet been captured in payrolls. In July, that number usually adds about 270,000 jobs. So, and again, we have this seasonal issue. So I think there are a lot of factors here that are distorting these numbers. But I think broadly, another point that Steve made about the government employment is so important because, as he's highlighted, they were the big contributor to jobs, not just in the last year, but post-COVID. And state and local government surpluses have now swung to deficit. Bloomberg had an article that states are now cutting spending at the fastest rate since the Great Recession. One presumes they'll be cutting heads at the same time. They're going to lay off a lot of people. So that sector that had contributed they accounted for 77% of the job growth post-COVID, is now going to exert a drag on these employment numbers going forward. So I think that's an important consideration.
Well, where does this go from here then, Stephanie? Do you think things continue to weaken on the macro story?
100%. I mean, I would take issue a little bit, or not take issue, but I'm not surprised, contrary to John, at the surge in the unemployment rate. If you look at a chart, when you go up half a percentage point, you then go up 2.8 percentage points on average, and you do it in straight line function. The chart of the unemployment rate goes like this, So I expect we'll see this unemployment rate somewhere near 7% within a year. I think we're in a recession. The Fed is behind the curve, and the market is just figuring out all this, now rear view mirror, looking at all the data that we've been looking at forever, showing the consumer is in recession. Companies are now laying people off. Earnings are coming in really disappointing. When you get high-profile companies like Amazon, Intel, McDonald's, Ford, Starbucks, I mean, the list goes on and on, Nestle, P&G, the earnings numbers have been really disappointing. And so can the Fed provide enough liquidity to offset the earnings drag? They don't seem inclined to do that. And then finally, I would say Powell probably had seen at least some components of this report when he stood up and gave his presser on Wednesday. So he was probably aware of some of these components, and his hair was not on fire. Maybe he had been a little dovish, but he certainly wasn't hysterical that the Fed was so behind the curve. So I think the markets are headed for some trouble here with not forthcoming liquidity in the face of declining earnings.
Well, Julia, you mentioned it earlier,
than that,
exactly what the chart says, that the jobs are in healthcare and government. Tell us more about your takeaways from this July report.
Well, the takeaway is that private sector labor markets are struggling and suffering, and they've been decelerating really quickly, and they haven't leveled off, and that suggests that this will go on. Consumer loan growth, commercial real estate loan growth, business loan growth, they've all ground to zero, and that's going to have effects over the next few months on job creation as well. So the Fed's characterization of a strong labor market this week seems like it's outdated. It's not going to age well. They may be very much behind the curve.
Well, what do you make of this sell-off here in reaction to this? Joel, clearly the macro story is slowing. You're hearing what the panelists are saying, that it will continue to do so, and yet the market has been priced for perfection.
Yes, the market has been priced to perfection. We've got to recognize small caps up until recently have not benefited from this market performance. It's primarily been driven by the mega cap stocks and fewer than 7 companies for the large caps. And for the small cap indices, it's primarily the large and mid cap stocks within those indices. So the underlying layer has been suffering. And in fact, the job market has not been equally distributed. The small companies, those under 50 employees, 49 and below, have actually lost jobs and not a positive growth. It's been a negative growth market. And so we've got to understand this is not a market that's evenly distributed. People have talked about healthcare and government sector has been rising for the last a few periods, and that is starting to slow down in this market as well. But within the large cap stocks, it's been very uneven. There's only a handful of companies, about 20, 30, primarily entrepreneurial companies that have been growing. The underlying layer has been slowing down quite a bit. Some are very negative. Your other panelists mentioned Ford Motor and other companies where the big ticket purchases are coming down. And so the market is slowing. I'm concerned this is the biggest jump we've seen in a few years in terms of 0.2%, 4.1 to 4.3%. And so it is escalating. I don't think we're in a recession. I think the markets will mitigate some of the negativity right now because of the anticipated rate cuts. But it's certainly a very weak picture.
I want to look at that chart again that Steve Moore brought us from the Bureau of Labor Statistics, because I think it's interesting not just where the jobs are, but where the jobs aren't.
That's right.
Look at the sectors that have lost jobs, Steve.
Right.
Information technology, down. Okay. Transportation and warehousing, down. That has to do with the high cost of oil and energy. And information technology has to do with disruption. We're seeing a lot of layoffs in that sector.
Yeah, we need to be making things again in this country. And, the government doesn't make things. And by the way, a government job is not real. A government job just takes the job of a private sector job because it doesn't add any productive capacity to the United States. Manufacturing has been pretty weak. And so the way I would put it is over the last year, we've been creating jobs in all the wrong places. But I want to make another quick point, if I may. Your friends on Wall Street obsess about what the Fed is going to do, and I certainly agree there will be 1 or 2 more rate cuts coming in September and October. But if you look throughout history, I was looking at the numbers over the last 40 years or so, and Fed rate cuts oftentimes are not the economic or stock market salvation that people think they are. I mean, if you look at back like in 1973, 1974, when the economy collapsed, the Fed was lower in rates. Same thing in 2008 when we had the financial market meltdown. Same thing during COVID. And so I think there's too much obsession Wall Street about interest rates at a time when the problem with the economy is not that interest rates are too high, it's that we have way too much government spending. We're running. Maria, in the last year, the national debt has risen by $2 trillion. That's lunacy. That's crazy. And nobody in Washington is talking about cutting government spending.
Yeah, that's exactly right. It's a great point. And the Fed has been up against this tsunami of money, too many dollars, chasing too few goods. I mean, the Fed has done what it can to rein in inflation by raising rates 11 times. They need a break in terms of the fiscal side of the store. and we haven't seen that yet. Stephanie Pomboy, where is this going? Market down 3 in the triple digits. You just said market is not going to react well. How sizable a sell-off are you expecting by year end?
Well, you know, I've been saying this for so long, Maria. I'm pretty chastened and reluctant to go out on a limb with a forecast about how much the market should go down. But I mean, it's so overvalued. If you look at sort of that Buffett measure of market cap to GDP, you're talking about, I mean, I hate to say it, but close to a 50% overvaluation here. So this is, you know, pretty substantial. If you look at credit spreads, that's an area that I've been really focused on. You really haven't seen any recognition of risk in the face of this incredible wave of corporate bankruptcy filings, and you know, all the refinancing at higher rates and the diminishing interest coverage ratios as a consequence. And that's really surprised me. And I think all of it has been built on this promise of a Fed pivot, and that, you know, the problems we were seeing were just temporary. The high rates that we have experienced for the last 2 years are a temporary phenomenon, and we're going to go back to the normal 0% world, you know, 0% interest rate world that everyone thought was nirvana. I strongly question that thesis. Because, as you said, you know, the Fed appears to be in a box. Yes, maybe they cut, but the inflation numbers still aren't quite where they need to be. But again, you know, they're behind the curve here, and I think they will cut. But again, Powell probably had some of these numbers on Wednesday, and he was, you know, pretty much down the middle there. So I don't get the sense the markets are going to get the rate cuts quickly enough and materially enough to forestall a deeper correction. And then look at what happened in Japan overnight. I mean, the worst decline in their market since 1987.
That's right.
That's massive. So there's a risk-off mood in the global marketplace. It's not just domestic right now.
I'm really glad you mentioned Japan. Japan was down sharply overnight, and it's like the worst two-day rout in Japan since the tsunami. We know that Japan just raised interest rates. That impacted the Japanese yen, and we've seen selling ever since. But I want to look at inflation in this country, Cheryl. We did have a peak in inflation within these jobs numbers with the average hourly earnings.
We did, and what is interesting about these numbers is there's not an inflationary story, there's an economic story with this data. Because if you look at average hourly earnings on a year-over-year basis, I think that's a better indication here. It was 3.9% for the month of June. In July, that came in at 3.6%. And also we saw, you know, a fall month to month as far as average hourly wages. Here's the thing. McDonald's, perfect example. The airlines, all these consumer products companies that are telling us people are pulling back, people are spending. If someone can't afford to go to McDonald's, if someone is saying that's too expensive for me, global sales were down 1% at McDonald's. They told us that earlier this week. What does that tell you about where the American consumer is? So that's what this data in this report also reinforces. They are making less money. There are not as many job openings available, and fewer jobs are being created. All of that is that economic storm. Whether we're going to go to a recession or not, I'm not going to make that prediction. I'm like Stephanie, I'm just going to wait and see. But I will say that consumers are struggling, and that is 2/3 of the U.S. economy. You know, don't forget that. And that's the mark. We're clamoring for rate cuts all year, and now we might get a 0.5 point in September, and the market is throwing a tantrum. So I don't know what to say about that.
I'm reading Fundstrat, Thomas Lee, because he's been so spot on, and of course he's been saying to buy stocks, and he's been right. He said this: did the outlook for stocks suddenly become bearish yesterday? The answer is no. 4 reasons why this will ultimately be a buying opportunity, says Tom Lee. Of course, we saw a huge sell-off yesterday. He says the most notable move is what you mentioned earlier, Cheryl, and that is the probability of a 50 basis point cut in September. Yesterday, that probability reached 29.9%. It was 14.4% on July 31st. So just yesterday alone, it doubled. So I guess when you look at the probability of a 50 basis point cut, Joel Shulman, do you want to buy this sell-off?
Well, I think we're going to let the sell-off continue. This, again, was a very negative report. There will be a large sell-off. We're seeing tech down, 2.5+%. So this will be a sell-off. But I think when the markets start to reflect later today and certainly over the weekend, I think they're going to look at it in a different light. And so today's going to be negative. We're going to see a lot of red across the board. And for all the reasons your panel mentioned, I mean, earnings are off. People aren't spending. I mean, they're not just spending less on big-ticket items. They're spending less on smaller items, too. And it's across the board. So there's a lot of negativity, but I think at the end of the day, I agree with Tom Lee.
Well, one of the reasons that Tom is calling this a buying opportunity is what we're seeing in politics. Steve Moore, take this on because Tom Lee tells clients the following. Recent presidential polls show Kamala gaining traction in key states, which in turn reduces the real-time probabilities of a Trump White House. Real Clear Politics betting average now stands at a Trump win of 51.3% versus a nearly 70% win after the first Biden-Trump debate. Is Kamala bad for the markets? We don't see this, but we also know markets prefer certainty, and a close presidential race is certainly not certainty. Steve Moore.
Yeah, I mean, there's been a romance period for Kamala over the last couple of weeks, and so Trump's odds of winning have come down. Now, look, I'm biased. I'm a Trump senior economic advisor, but I don't think there's any question when you look at so many of these industries, who would be better for the oil and gas industry? Who would be better for financial services? I mean, remember, we had an economic boom and a stock market boom, Maria, when Trump was president. The stock market has risen 25 or 30% higher in real terms under Trump than Biden. So I don't understand these economists who say things like, oh, Biden would be better for inflation and better for interest rates. Wait a minute. We had the lowest inflation and lowest interest rates practically ever when Trump was president. And so I guess I would conclude by saying I think that there is real nervousness about. And look, Kamala Harris is to the left of where Biden is on these issues. That's the thing. I mean, everybody's running around saying she's normal. She's a centrist. She's not a centrist. I mean, she can flip-flop on all these issues, but does anybody really believe she's anything but a San Francisco liberal Democrat?
Julia Pollack, tell me where this is going. If you were to see policies of Trump return to the White House, and that means unlocking energy potential, do you expect job creation as a result of unlocking energy potential, unlocking the spigots of oil and gas production?
It's very interesting. We did a survey of job seekers and asked them what they think. And among job seekers who think that Trump is going to win, they think that it'll have a huge positive impact on the economy. Among workers who think that the Democrats will win, they are much less likely to think there'll be a positive impact on the economy, which is sort of interesting. They're clearly voting for other reasons. My focus on this report, though, is on two numbers: the decline in the work week and the increase in temporary layoffs, a large increase, almost 250,000 workers. And that suggests to me that companies are under stress, but they're hoping for a change. They know that this is just a temporary thing, that this is because of high interest rates and that the Fed could turn this around pretty quickly. So all of these losses, this weakness, it could turn around. And that's the suggestion here, that these are temporary measures that companies take, cutting hours and putting people on furlough. These workers can come back to work.
Well, you got to keep your eye on consumer spending. I mean, that's going to be very important. This report, with the smaller than expected increase by payrolls, the downward revisions, the slowdown in wage growth, this tells me that consumer incomes are growing more slowly. So it would not be surprising if companies find that they have overestimated sales, if companies get stuck with more unwanted inventory, if service providing companies find that they're not fully utilizing their existing staff. That implies more layoffs and even slower personal income growth, and in turn slower spending. I think we might well be at the start of a downward spiral for consumer spending that will eventually lead to a recession.
So Tom Lee tells clients that over the next few weeks, there are some important macro data points, and they matter. Post-FOMC, there will be numerous Fed speak moments. They will clarify the why wait for September, and we expect lead investors to be confident that September will happen in terms of a rate cut. Stephanie, what do you make of Tom Lee's note today? He says this will clarify the why wait for September, and we expect the July CPI number, August 11th, and tame inflation reports will still matter.
Well, again, I mean, I think the market, obviously, as discussed here, is fully priced in that September rate cut and then some. So is ratifying that expectation going to really be supportive of equities at this point? I'm not really sure. I mean, look at the tape that we're seeing so far. They're pricing in more rate cuts than they were yesterday, and the market is still under heavy pressure. And again, this narrative is, the question, is the Fed too late? Is it too little, too late? You know, if you were a junk-rated borrower and you have 8% paper that's rolling 150 basis points lower because the Fed is going to cut 150 over the next year and a half, as the markets expect, does that really save you? Not if earnings growth is slowing on the back of this consumer slowdown that John just talked about. So, you know, the other thing, on a side note, we were talking about the political outlook and the factor that it may play here. I think it's interesting if you contemplate Scott Besant's thesis that the market was going up in anticipation of a shift to a Trump pro-business, pro-growth policy. And then as soon as Kamala had her transformation from, you know, the lowest rated vice president in history to Margaret Thatcher, suddenly the market starts tanking. You know, maybe there's something to the idea that the markets are now nervous because they see there's a chance that we might be stuck with these same anti-business policies, woke green energy, higher energy prices, higher taxes. I mean, if that's the narrative, I would be selling stocks hand over fist as well.
I think that's right, Stephanie. I really do. I think that's spot on. This is also part election related, what we're seeing.
Yeah.
But Cheryl, take us back to what you were saying earlier about the probability of a half-a-point cut in September. I don't know how markets would view that. I think they might view it negatively. I don't believe it. I mean, I know that the probabilities have increased, but I do not see the Fed cutting rates by 50 basis points in September. Tell us more, Cheryl.
Believe me, that's why that surprised me and why I jumped in earlier, because that is a very extreme bet. And I watch these, well, every day pretty much, and I've never seen that type of move based off of one data point like the jobs report that we got today. But I also want to remind everybody, another reason we're seeing this huge, sell-off is, of course, because of technology stocks. I mean, look at what look at Apple, look at Amazon today, look at Microsoft. Intel's getting crushed in the pre-market. So 20%. Yeah. So I mean, and you had mentioned the sell-off in tech that we've seen since June. So I think we've got two conflating factors right now that are hitting the markets. We'll see how we close, but it doesn't look so good as we go to the open.
So next week, what are your eyes on in terms of market catalysts? I mean, we are going to probably get Kamala Harris's vice presidential pick by Tuesday. She's going to want to campaign with whoever that person is next week. I'm expecting it by Tuesday. Finalist, certainly Mark Kelly from Arizona. Steve Moore, does Mark Kelly help Kamala with Arizona?
It's not going to be Mark Kelly. It looks like a very high probability it is going to be Shapiro. Shapiro is the governor of Pennsylvania. Nobody knows. I bet nobody on this panel, none of us know a whole lot about him. And so I don't think he's going to help much. But it is certainly going to be about those 4 or 5 states, Maria, that we've talked about, Pennsylvania and Michigan and Arizona and Georgia and so on. But Stephanie made a really good point that we haven't mentioned, that the Democrat agenda is higher taxes. How's that going to help?
Good point. Julia Pollack, Steve Moore, Stephanie Pomboy, Joel Shulman, John Lonsky, Cheryl Casoni. Great conversation. Join me on